Welcome to this JetShip Worldwide presentation, Understanding Value-Added Tax. Simply put, value-added tax is a national tax regime that many countries apply to the sale of both goods and services. This form of national tax can also be referred to as goods and services tax, provincial sales tax, harmonized sales tax, SST, IVA, KDV, PPN, or other acronym. Value-added tax is often compared to sales tax in the United States, insofar as both are taxes on consumption. The key differences include that VAT is administered on a national level, while sales tax is administered at a state, county, city, and local level. VAT typically applies on the sale of both goods and services, where sales tax typically applies only to the sale of goods. And businesses can often claim back VAT. While companies reselling goods may be exempt from sales tax, businesses in the United States are most often not able to claim back sales tax. It's a non-refundable cost. The theory of value-added tax is that tax is only paid on the added value of each phase of production. Businesses pay VAT but can claim back VAT they charge on their sales. Take this example. A company paid 40,000 UK pounds in value-added tax for their purchases and charged their customers 60,000 pounds in value-added tax. In this case, they would have to remit 20,000 pounds to the government, effectively wiping out the VAT paid on their purchases. By contrast, businesses in the US simply pay sales tax. It's a non-refundable cost, and such costs accumulate as intermediary goods are bought, sold, and cross the production processes. Recently, value-added tax has been added into the trade discussion, but it really is a taxing policy with respect to consumption. Again, it's national versus local. VAT applies to both goods and services. Sales tax applies only to goods. And value-added tax is meant to really be applied only to the final consumer, where sales tax applies to every transaction across the production process. With respect to imports, imported goods are subject to the same VAT rules as domestic goods. By contrast, sales tax is applied for most goods purchased by consumers from overseas sellers, namely via e-commerce platforms, but businesses most often do not pay sales tax for goods purchased from overseas suppliers. Actually, payment of sales tax is not even a consideration for U.S. customs. Keep in mind, however, that sales taxes are subject to a myriad of state and local rules. For exports, neither sales tax nor value-added tax are charged. For exports from countries with VAT, that means that VAT has been avoided across all phases of production. But for U.S. exports, they're not able to claim back sales tax paid on the goods that they put together in the United States and are exporting. Even if they don't charge sales tax for the final export, they've paid sales tax in the production process. And there you have it. Jet Worldwide, connecting people, products, and businesses around the world for over 40 years.